Hello, this is Jean-Charles Bagneris. Welcome to this new screencast, and today we deal with stock valuation. As for any financial asset, the stock price will depend on the future payments you will receive by investing in the stock and on the rate of return you expect from investing in the stock. In the stock case, the future payments are the dividend stream and then the price at which you would sell back the stock when you choose to do so. Let's start with a very simple exercise. You buy one share of ABC stock at a given price. After 1 year you receive 1.2 dividend, and then at the end of year 2 you receive a 1.4 dividend. You then decide to sell the share on the market. The stock price at that time is 48.9. Your overall return is 14.5%. What was the stock price when you bought it? So here we build the stream of future cash flows. So here 0, 1, 2, we have 2 years. Cash flow. So in year 1 we receive a 1.2 dividend and then 1.4 plus we resell at 48.9. The rate R is 14.5%. Then I just have to discount the cash flows. So I take the present value of my cash flows. So here the cash flows divided by 1 plus rate, the power of year number. I do this for the second one and just add the two present values to get the price. So here the price was 39.41. So here the stock price depends on the future dividends and a future stock price, which itself may depend on a future stream of dividends and again a further future stock price, which itself again may depend, etc. That means that we may value the stock based on an infinite stream of future dividends. Let's try this new model by assuming that we have a constant growth rate of dividends over time. So let's look at this new example. The XYZ Corporation plans to pay a 3.24 dividend at the end of the year. The analysts, they expect this dividend to grow on average by 1.9% per year in the future. The shareholders' return should be 14.8%. So what is XYZ stock price? So here we only know the next dividend, which will be 3.24. But we know in addition that this dividend is supposed to grow on a yearly rate of 1.9%, and this forever. Well, at least we assume it's forever. That means that from dividend 1, the next dividend we call dividend 1, you can get, of course, dividend 2. And then from dividend 2, dividend 3, etc. And of course, as usual, we have a shortcut formula for this case. Let's have a look at this shortcut formula. So here is the constant growth rate dividend model. So here we get the stock price at time 0, P0, depending on next dividend, D1, over a rate of return, which is of course the required rate of return from the stockholders, and the growth rate of the dividends, so R minus G. Of course, for this model to hold, the dividend growth rate should be smaller than the expected rate of return on the stock. Now we use the model on our exercise. So here D1, the next dividend, is 3.24. Okay, the growth rate G of the dividends is 1.9% per year, and the expected rate of return on the stock is 14.8%. Then I'm looking for the price now, P0, and it should be dividend over rate of return minus growth rate. So here the stock price should be 25.12. Thus, this model is very convenient and easy to use, provided, of course, you have the dividend growth rate. Then the next question we have to address is, how do you estimate this future growth rate? Well, for mainly empirical reasons, most of the time we try to estimate the future growth rate from the past growth rate. This is what our next exercise is about. So here we have a dividend time series from 2003 to 2007, and the question is, what is the annual compounded growth rate of the dividends below? So we are looking for the rate here. Of course, the question is about the average growth rate on the whole series. That's the reason why we will deal with only two dividend values, the dividend for 2007 and the dividend in 2003. So how do we get this? Let's look here. Here I wrote again the relationship between the first dividend of the series, so for us it's the dividend of 2003, and the last dividend in the series. So here we have the future dividend, dn, is d1 times 1 plus rate to the power of the number of periods, of course. This is actually the value you get from a compound growth. Then we try to find the rate g here. So I just write it again the other way around and then get 1 plus rate to the power of the number of periods here in this ratio. And finally I have 1 plus rate is the ratio of the last dividend over the first one to the power of 1 over the number of years. So now let's use this on our exercise. So here the rate should be last dividend value over first dividend value to the power of 1 over the number of years. That's 2007 minus 2003 minus 1. And here the dividend growth over the 4 years here is 2.60% per year. Of course, deciding whether this value is a good estimation for the future dividend growth rate is another question. Thank you very much for listening. Goodbye.